Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is going. This week's video is going to focus on the SP 500. I'll discuss the ASX 200 and gold in a separate video, and I'll leave a link for that in the description section below. I've also got some fascinating graphs for you from outside the US, which is really going to help understand where the stock market could be going, so make sure you stick around for those. As always, this is general commentary and doesn't take your personal situation into account. With all of that said, let's get into our first chart. So here we go. We've got the SP 500 up on the screen, and geez, it has been an ugly week of price action for the SP 500. And prices are now, they're broken down below this support band. So we've been watching this support band in here around 3,900. And we've now broken below there, and I think that puts the S&P 500 in a very vulnerable position. I think the fact that the S&P 500 has broken this support zone, and that it's below the 50 and the 100-day moving averages, I think that's cause for some extreme caution as we move to the end of the current week and into next week. I think if we're going to see a sharp decline, then the market is now set up for that to happen. Now, I'm not saying that that's going to happen because, of course, I don't know. We don't know what the market's going to do here. Lots of people are going to speculate about it's going to do this, it's going to do that, but none of us really know. But I think the window is now open for something ugly to occur. But look, I've got to qualify that by saying betting on a crash is always a lower probability event. So you just always got to bear in mind when you're looking for sharp moves down. But as I said, the S&P 500, it does have the setup from which a big and a fast move lower could occur. So I think also with much of that September nervousness in the market at the moment at current levels, I think we just can't rule that possibility out. Now, I think that the key feature on this chart remains this downward trend line, 3-point down trend line, which has been in place since the high at the beginning of the year. And with that firmly intact, the primary trend remains down. And I think the first step in breaking the current sell cycle that we find ourselves in, I think the first step in that would be breaking back above this resistance band at around 3,900. So this was support, and once support breaks, support becomes resistance. So the first step in breaking this sell cycle is to have the market break back up above there. And we can also put some Fibonacci retracements on from the high last a week ago. We used the current low. We don't know whether that's going to actually be a low of substance. Probably not at all. But if the market were to bounce from here, just gives us ideas as where it would need to get to break that sell cycle. So looking at these Fibonacci's, they do come in around this resistance band at around 3,900. So that's the look. I think that's very much the mark to watch, to see if the market can move into a more neutral state. And I think so while this level's intact, we could get, this is a thing to remember, we could get a 3% rally from here. We could get a 3% rally back to this resistance band, but still keep the sell sequence in place. So from there, the market could then turn lower again, and the sell sequence could remain in place. So even a rebound doesn't neutralize this market at this point. It really needs to get back above this resistance band to get things back to at least a neutral state, not necessarily even a bullish state, but just neutral. At the moment, we're in a high risk sell sequence which could unravel considerably from here. So it's something we need to be mindful of. And if you've been following these videos for a while, you know that my approach since back here in early July has been to incrementally get some exposure to the market. Not a lot, but just enough to have a base position in the event that prices pull back and then had another leg higher. Not necessarily a new bull market, but even just a prolonged popping formation could have seen the market go higher. But I think what we've got now, it's been a case of the last few weeks holding the line to see whether this support would hold. But now with this support giving way, it's I think the prospect of that larger rally is a whole lot less likely. And I've actually unwound some of the positions which I put on during this rally. I've still got market exposure, but I'm mostly in cash. It's not about fighting the market at this point. We have a primary downtrend. The rebound we had hasn't materialized into a larger rebound, so it's not now time to dig in and fight the market. The trend is down. We need to respect that. And now look, if you're getting some value from this, please hit that like button, and please hit the subscribe button if you haven't already. And also, please leave a short comment. Just, hey, Jason, thanks for the video. It helps so much. It tells YouTube people are watching, people are engaging, and YouTube shows more people. Now, if that's happening, well, then I make videos. It all works. So that helps me heaps. So please do it, because it takes a lot of time to put these things together for you. So I really appreciate that so much. And I think the biggest reason for the market not to crash, at the moment, is that sentiment is just so extremely negative. And markets typically don't crash when everyone's watching and everyone's waiting for the crash to happen. So I saw a survey came out through the week. It's the AAII sentiment survey. So that's the American Association of Individual Investors. And they've been doing these surveys since 1987. So this came out through the week. So this is for up to the 21st of September. Came out showing that 60.9% of respondents are bearish on the market. Now that's a lot. That's actually, it's one of the 5 highest bearish sentiment readings in the survey's history, and that goes back to 1987. And so, look, I see these big sentiment readings, and they're just hard to get to really say, well, look, a crash is on when so many people are negative. Of course, this doesn't mean that the market has to go up, but we do know that bearish extremes do occur around lows. While this one here, this is now it's very much in that extreme, it's in that extreme zone. Of course, we don't know if it's going to get even more extreme. So that does, it does keep that window open for further selling from where we currently are now. But it's something to keep in mind. And another factor that makes me a little bit hesitant towards this idea that a crash has to happen, which so many people seem to believe as a foregone conclusion, is that markets are also very oversold at current levels. So if we just look at this is showing the number of S&P 500 stocks above their 20-day moving average. And for several weeks, we've been right down here at the bottom of the range. Currently, it's just 5% of stocks above their 20-day moving average. This is on a weekly. I'm looking at this on a weekly graph. And so let's get a little bit more data on this. So this goes back to about 2008. There we go, back to 2007. You can see that when the market gets down to this oversold level, it doesn't stay down here for too long. We've been down here for several weeks, so the possibility that it's going to remain down here for several more weeks, well, it would do something which it hasn't done before. So from that basis, from the sentiment, overly negative sentiment, and from the oversold state of the market, it does make me wonder whether a crash would happen, whether it could happen. Look, of course, it's always a possibility, but there are reasons to believe that maybe the market continues to sell off, but it does then stabilize. We just don't know. We've just got to wait and see. Now, I quickly want to show you some more charts of concern. And for this, we're going to jump over to Europe, because this is interesting. We don't often look at the European markets, but they're really getting to a critical level at the moment. So this is the Euro Stocks 50, so the largest 50 European stocks, and it's coming right down to a key support zone at around 3,370, also below the 50 and 100 day moving averages, and it's approaching this support zone with a bit of momentum. So I think that the risk here is that this support zone gives way and the market continues to unravel. And the price action since March has also formed what we call as a descending triangle. So a descending triangle works like this. So you've got your top trend line, and then you've got your bottom trend line. And so you've got the descending line on top, and you've got a flat line on the bottom. And the theory with a descending triangle is that the sellers progressively get more aggressive as you move towards the apex of the triangle, whereas the buyers just hold the line. And ultimately, the buyers overrun. Ultimately, the sellers overrun the buyers, and you get the price falls away. At the moment, it looks like the buyers are about to be overrun. So it's this is how the European market's looking. Europe breaks down. You'd expect it's all part of a broader global equities sell-off. So it's something really important to watch. Same structures evident in the Euro Stock 600. It's sitting on this big support zone. And when we go to the German market, the DAX, it's got the same sort of pattern. The DAX is it looks like it's starting to roll over, and that has a potential to continue to fall away. So it's something I think we need to keep a close eye on. Looking at the UK, it's got this large triangle trading range, and it looks like it is testing the lower support of that triangle. If that breaks, that has a measured count for a fall of upwards of 10%. So significant things going on in Europe. So I think the deterioration in the price action that we're seeing opens up some extra risk going into September. And if you've been following these videos for some time, you know it's all been about playing defense. For much of this year, it's about playing defense. Nothing has changed there. Could be an interesting week. So let's watch it closely. Let's watch those levels. And I look forward to coming back next week and talking to you then. Until then, bye for now.